Good afternoon. Hope like I'm audible and you can see the screen, right?
Good afternoon, sir. Yes, you are audible and we can see the screen.
All right. Thank you. Um, this is the last class. So today we are going to discuss international finance and monetary policy. So basically, an exchange rate analysis, foreign exchange analysis, and then how a monetary policy can have impact on exchange rate. So that's the overall aspect of this one. So we will be seeing what is foreign exchange rate and how we arrive that rate, and what are the theories involving in this foreign exchange um, analysis, and then what's happened to a country uh, when it's off. Okay, so let me start with the basic aspect of this foreign exchange rates. So basically, this foreign exchange rates are determined at the foreign exchange market. So we always have two markets in our mind. One is financial market, another one is goods and services market. It's basically a good market. If you want to buy goods, so you are going to buy from the market. So the price of the good is determined by the uh, buyers and sellers. So demand and supply curve. Like that, in financial market, the price where the interest rate is determined or exchange rate is determined, right? So we have seen how interest rate determined, right? So today we would be seeing the exchange rate. So basically an exchange rate also determined through a financial market. We call it foreign exchange market, right? So when it comes to exchange rate, we call it like, okay, a price of a one currency in terms of other currency. Now, what's the price of rupee? We would be saying maybe 1 rupee is maybe $0.02. So we would be quoting a price of one currency in terms of other currencies, right? So that's basically exchange rate. So when we quote exchange rate, you would see, first of all, in text or theories, how do we mark it? You can see the screen, right? The first, I have given two codes, right? One is pounds to dollar, another one is dollar to euro, right? So if there's a calculation, don't get it confused. So you can see E is the exchange rate we denote, and then first it's a sterling pound divided by dollar. That means how much a $1 worth in terms of sterling pound, right? So $1 is equal to, because the we divide here sterling pound divided by dollar. So $1 is equal to 0.63 pounds, sterling pounds. So that's what we should understand. And then second, we also say 1 euro is $1.35. So don't make it confused. Sometimes it may be confused how to read this. So this is the way, and if you confused even, most of the time practically, as a banker in the market rate, okay, the sterling pound is like in terms of conversion, you can compare Sri Lankan rupees in between and see, okay, sterling pound is valuer than dollar, so then you can understand. So similarly, like euro is valuer than dollar, I'm in terms of one, right? When we look at that, so you could see that kind of confirmation from when we talk about the exchange rate, right? So this is, we call it exchange rate. And also two rates we regularly use, that one is spot rate of exchange, That means if you're going to buy over the counter immediately, you pay your local currency and you buy dollar, right? Instantaneously, immediate delivery. So that's, we call it spot rate, right? If you want to buy dollars, if you go to a bank over the counter, you pay Sri Lankan rupees and buy dollars. Okay, that's it. So that's a spot rate, we call it, right? Immediate delivery. And then there's a rate for like forward exchange as well. We call it forward exchange rate, right? Where the delivery will be taking place at a future time, right? So that is forward exchange rate. Now, if you are going to import a car from Japan right? So you are going to pay that, okay, in 3 months time. So you want to make a payment in 3 months time. So, but you are not sure about the rate at that time. So today also, like, but you want to fix it today. You don't want to pay it today, but you want to fix it today. But the thing is, you are going to pay at the end of 3rd month. So you can go to a bank and you can enter into a contract that's a forward contract, and you can say, okay, I'll be paying rupees in 3 months time, and what rate you are going to give me dollar. And they will say a rate, maybe that's a little bit higher than the spot rate. If market is as usual, then you can fix it. So after 3 months, you can buy dollar by paying your local currency. So that's a forward exchange rate. So always in our Sri Lankan market, these are the major transaction we used to have in addition to swaps, right? Swaps anyway, like for local, traders, or like normal usual buyers, business people, it's very rare, right? Only swaps, it's happening between the counterparties, banks, or like within countries, between countries. So something like that. So if you can understand the spot rate and forward, of course, that's sufficient for these discussions. I also hope like you might have already discussed, because derivatives and all already in your syllabus. I think you have covered that, right? So that also you could see based on your discussion previously you had. Okay. And also, like, we regularly use words appreciation, depreciation. So when it comes to appreciation, you should be able to feel, okay, a currency rises in value relative to another currency, right? Now, if dollars are rising in value related to Sri Lankan currency, that's a appreciation. Or like if it is vice versa, other way around, we call it depreciation, right? So foreign currency, if somebody asks whether it's appreciated or depreciated, you should be able to explain, right? What's the impact? So the impact when a currency appreciates, right? Those countries' goods become expensive, right? If Sri Lankan currency appreciates, so our goods might be very expensive for other countries, foreign countries, right? And also the foreign product may be cheaper, less expensive to domestic economic agent, right? So that's what, like, a country should be very vigilant to see whether the local currency appreciates or depreciates, right? So we should be having more understanding on that, because like even local exporters in Sri Lankan perspective, right? When a currency depreciate, right, the exporters will get more money, right? So, but the problem is importers may be having negative impact. They have to pay more, right? So then government or policymakers should play a bigger role to have a fair exchange rate. You cannot let it appreciate too much, or you cannot let it depreciate too much, right? So you should now should be knowing, like, okay, what is exchange rate, what is spot rate and forward rate, and what's the differences between appreciation depreciation. So, and when it comes to now you also should be able to understand, okay, how this currency conversions calculated. Now if it is a direct forward between two currencies, right, there's no issue, you have the rate, so market determine, right? We call it hard currencies. You have always the rate, market rates in place. But sometimes you don't get exchange rate where the currency is soft, that means not readily available, not used by many people, so you don't get the exchange rate. So if you don't get the exchange rate, so you should use a cross exchange rate calculation, and you should be able to find out the what is cross exchange rate. So we call it cross exchange rate. You will have two exchange rates, right? And you will be arriving to a third exchange rate. So here I have given one example. You could see the first one is the exchange rate of a euro. 1 euro is how much of dollar, and 1 sterling pound is how much of dollar. Now let's assume you don't have euro to sterling pound exchange rates. How do we calculate? So it's straightforward. You don't need to confuse so much, right? So now if you are going to calculate here, you could see if you are going to calculate euro to sterling pound, right? Just you can think of dividing the dollar to sterling pound rate by dollar to euro rate, right? If you can just work out, then you will get a cross currency, right? It's a straightforward, but only thing is the people get confused, right? So here, like, finally you have to like double check the answers, right? So normally I'm going to get a euro to sterling pound. That means 1 sterling pound is how much worth in terms of euro. So it should be more than one, right? That's what you can see practically. So then if you get that more than one answer, definitely your answer is correct, right? Because people sometimes confuse, okay, which one to divide and which is the denominator and which is the numerator, right? So something like that. But you can easily confirm whether your answer is correct, because it is more than one for this exchange rate, right? So there won't be any issue. So just think about that also. I just said how to confirm your answer, right? So you should be able to calculate that as well. So that is we call cross exchange rate. Okay, up to now, is there any questions you have? Okay, so now we are going to a area where we have a very important theory. We call it law of one price, right? So law of one price theory explain the exchange rate relations, right? What does that mean, right? If you want to buy a goods, right, anywhere in the world, the price should be equal, in a common currency. That's a law of one price. That means the goods should be sold at one price if you calculate in a common currency. Now let's see, you can buy burger from any countries around the world. Sri Lanka you can buy, or Canada you can buy, or Australia you can buy, or England you can buy, even India you can buy. But if you convert those prices into dollar, the prices in dollars terms should be equal or one price. If you in US dollar term, if a burger sold at $1 in US, so that should be equal to that $1 in Canada as well, or in Middle East, or India, or wherever it is. So that's a law of one price theory. You take Sri Lankan, maybe 400 rupees a burger, then you convert, let's assume to a dollar is 200 rupees, so then $2. A burger in Sri Lanka is $2. So similarly, if you go to US, so you should be able to buy the burger for $2 and anywhere in the country. So then law of one price says, the theory says, if you convert this price of a goods into a common currency, so everywhere that should be a one price or equal price, right? So now then based on that, you would be able to find the exchange rate. Right now, let's assume we will be we can see this formula here. You can see dollar price of a goods in USA, right? You are going to buy a product in USA, right? So the price of that product is $900, right? So when you have this $900 as a price, you have an exchange rate, right? When you multiply that exchange rate by this 900, then you will get the same gold price in peso, right, in Mexico. So when you buy a gold, right, let's assume gold price, so gold at a $900, in Mexico you should be able to buy that gold at 9,823 pesos, because the exchange rate is 10.9143. So when you multiply by your exchange rate, you should be able to buy at that price. This is the law of one price. Now you could see, like if you go abroad, foreign countries, we usually do it, right? So we check whether it's cheap in Sri Lanka or whether it's cheap in maybe some other country, right? So we
excuse me, sorry to disturb you here. 10.9143 equals $1, no sir?
Yes.
Okay.
That is the exchange rate.
Okay.
$1 is equal to 10.9143 pesos. Is that okay?
Okay, sir. Thank you.
Yeah. Usually when we visit other countries, we just if we want to buy a branded shirt, so we will calculate and see normally, right? It automatically happens and see, okay, what would be the price in Sri Lanka. So we usually, without knowing this theory, right, we used to do that, because like we compare, okay, whether it's one price, right? So this is the law of one price, but whether it's happening or not, it's a different story. But theoretically, that should be the case, right? But in practical terms, like I have given the explanation here, right? Why the theory says like that? right? It should be one price, right? Let's assume now if you see, let's assume there's no transportation cost, right? No trade barriers. It's freely available, right? Um, let's assume an example. Suppose the price of a pizza at one restaurant is $20, right? While the price of same pizza at an identical restaurant across the street is 40. What will happen? So you have like same pizza, the pizza sold in a two different restaurant, very nearby, right? One is selling pizza at $20, and other is selling at $40. What will happen, right? Many people go to the pizza like where it's sold at $20, and only few may be going for various reasons for the 40. But ultimately, what would happen is like everybody will be going to the restaurant where pizza is sold at $20, right? So there's no other way the $40 pizza like producer, he should reduce the price, right? Automatically he will be making 40, or then 35, then 30, and then 25, and then finally, because it's same pizza, right, we are talking about. So finally he should reduce his price, and he has to be par with the other restaurant. So you would be settled at the same price, so one price. So if you take a global, right, global market as a single market, you cannot have two different prices, right? Now it's becoming a single market. So because of this, like online purchases and all, anybody can buy at a cheaper rate, right? You cannot, very difficult to have two different prices nowadays, right? Now what you do, you go and check in Sri Lankan market, and you Google it and see what is in AliExpress price, or maybe Amazon price. So you check it and you buy it, right? Now it's because of this online development, you are very closer to this law of one price, right? You will calculate and see which one is cheaper. So like local dealers cannot do much on that. So ultimately, you would be settled at a one price, right? So if there's even different prices, after some time, you will reach to a one price. This is called law of one price and how that works. So definitely, you cannot, it's very difficult to have two different prices. I have given the example how we can calculate a exchange rate through this one law of one price, right? Consider like a pizza restaurant in Seattle, one across the border in Vancouver. This is the example from the textbooks, right? As we know, the law of one price is the price of pizza should be same, right, in a common currency, right? Let's assume the markets are very competitive, and transportation cost and barriers are not important, right? So then what you can do is, in this formula, if you take that pizza, Canada pizza, and multiply by the dollar to Canadian dollar, US dollar to Canadian dollar exchange rate, you should be able to get price of a pizza at US, right? So we make it in a common currency and calculate and see. So then Canadian pizza at US dollar should be equal to US pizza as US dollar. Is that clear? Hope everything's clear. Okay, similarly, now we talked about the pizza story or gold story, right? A one good, right? So based on this law of one price, we also have a theory called purchasing power parity, right? Remember purchasing power parity. It's an application of law of one price, right? So here we take not a single product, it's a basket, right? Group of goods and services. It's a basket of baskets of goods and services, right? So then you get a price level. Now we discussed, you can recall, it's a gentle price level I'm telling now, right? Okay, so again I recall, right? In Sri Lanka, when we were talking about the inflation, what is mean by inflation? The inflation means it's a continuous increasing gentle price level. You can recall. So what is gentle price level? It's basically a calculation. So we take a baskets of goods, we put selected goods into that basket and calculate a weighted average price. So that's a gentle price. So when the gentle price increases, you say that's inflation, right? So every country, they have this gentle price level. So the purchasing power parity says, if you take a Canadian price, average price level, and then multiply by the exchange rate, you will get US price level, right? Here earlier we discussed about one product, that's a one price. Now we are applying that one price in a macro perspective and say, right? So when you take the Canadian price level, average price level, and if you multiply by the US Canadian or USD Canadian dollar exchange rate, you will get the US price. Clear? In a macro perspective, any researchers, any analysis, normally the purchasing power parity PPP is used, right? So now it's very simple, straightforward, nothing to worry. Like as you just individually, in a micro perspective, you just check law of one price always. But in a macro perspective, right, law of one price is across like applicable to all goods and services. So it's a purchasing power parity, we call it. If we are going to take any decision country level, or if we are going to manage our price level, if we are going to manage exchange rates, so this purchasing power parity is very vital for that kind of analysis. Is that okay? So now we can normally, right? So then based on this formula, this slides formula, I said, okay, you take the Canadian average price level and multiply by the exchange rate, and you get a US price level. They're using the same formula, just slightly change, and that implies you can get the USD Canadian dollar exchange rate by dividing US price level by Canadian price level, average price level, right? That means finally you can conclude the exchange rates are determined by the price level, average price level. Is that okay? Up to now, it's clear?
It's clear, sir.
Okay, hold on for a while. Okay, you can look into this example as well. If the price level in the US is USD 200 per basket, while the price level in the Canada is 400 per basket, you should think like it's a similar basket, right? The goods are same, right? So in US, the basket price is 200 bucks in USD terms, but in Canada, it's 400 bucks, right? So based on the purchasing power parity, you can see the exchange rate. That means you are going to divide Canadian dollar 400, right, by 200. That means $1 is equal to 2 Canadian dollar, right? So you can take the price level and you can compute and see, right, your exchange rate. Why this is very important? Now, when you forecast the exchange rate, or when you think about when you see the trends or what would be happening for exchange rates, you basically take this price level and the expectation of the inflation. So you should be able to understand now the inflation. That means continuous increase in the general price level, right? So the expected inflation would be factored and you will forecast the exchange rate. Now you take Sri Lanka and US, right? And if you think, okay, in a present scenario, you can think of, okay, then Sri Lankan price is moving faster than US, right? That means Sri Lankan general price level, average price level, is moving faster than, increasing faster than US, right? It means then how do we perceive your exchange rate? Definitely, we know the USD, the Sri Lankan currency is going to depreciate, right? So based on the price level, right, your view on the price level, you can decide, you can forecast the exchange rate. Is that okay? I hope so. Okay, so purchasing power parity predicts that people in all countries have the same purchasing power with their currencies, right? So 2 Canadian dollars buy the same amount of goods as 1 US dollar, since prices in Canada are twice as high. That's it. And also you should be able to understand two kinds of purchasing power parity. One, we call it absolute PPP and relative PPP, right? Absolute PPP, up to now we have discussed, right? You get the exchange rate by dividing a US price level by Canadian price level or EU price level. That's absolute terms, right? But relative PPP, you are going to forecast the changes, right? So this what earlier we discussed. You can see from this formula, right? if you take, right, USD Euro exchange rates today and yesterday's one, so you are going to see the changes in the exchange rate. That changes, right? That's average changes, right? That's what we have divided by the previous exchange rate. Now let's assume USD Sri Lankan rupee is 200 today, yesterday is 180. So then you will have 20 changes for 180. It was 180 earlier and increased by 20. So 20 divided by 180. That's the changes in proportionate, right? That should be equal to, right, inflation in US minus inflation in EU, right? When you say inflation, what is inflation? That's also percentage, because now you take the general price level, right, and deduct the general price level, right, in a country and divided by the previous general price level. So you get a percentage term. So inflation also, it's in a percentage, right? So you don't need to divide here anything. You take previous inflation and current inflation. So basically, the idea is, when the Sri Lankan, as an example, when the Sri Lankan inflation is higher than the US inflation, what will happen? So your currency is going to depreciate. So what will happen is, when somebody is forecasting exchange rate, they will rely on the inflation forecasting, right? Based on the inflation forecasting, you would be able to forecast exchange rate based on this purchasing power parity. Is that okay? So silent, everybody.
The concept is okay, sir, but these equations gets us a little confused. I don't know, but the concept is okay.
Okay, because I didn't give any examples. That might be the reasons, but you just plug some numbers and see, right? So there won't be much issue on that. Just plug some numbers and see, right? What it says basically is, what would be the changes in the exchange rate? What would be the changes in the exchange rate that should be equal to the changes in inflation rate? That's what, right? So when the inflation rate changes in between two countries, their exchange rate also would be changing, right? So that is the relative purchasing power parity, right? Okay. When it comes to relative, we are talking about the changes, but when we are talking about absolute, we are just talking about the current level, right? Okay. If it is a physical class, we would pick some numbers and put it and see, but of course straightforward, nothing to worry. But now, up to now, we have seen how exchange rate can be calculated, or like how it's happening, right? So two basic theories, law of one price and purchasing power parity, right? The problem is, in the purchasing power parity, we have shortcomings as well. So you cannot expect always this would be the scenario, right? Based on the empirical results, it shows the prices of similar goods, if you convert into a single currency, it differs substantially, right? So you also might have seen your experience when you go up to other countries and you check the prices, you don't get that same price, right? But the evidence shows the relative purchasing power parity is more consistent with data, right? But that also sometimes when you predict your exchange rate, it's not perfectly happening. So there are it says that study says that also very poor, right? So even though the theory says like that, and most of the market, this is the basic, but it doesn't mean it's 100% or there's a correlation 100% in between the price level and the exchange rate, right? But this is the base for any prediction. As an example, this is also the chart is from the textbooks. You could see the price level in between Japan and US. It's continuously like dropping kind of a straight line, right? It's a downward sloping from 1980s to 2006. But if you see the exchange rate, it's not going in parallel way, but you can see ups and downs, right? So even though we say purchasing power parity, right, it's going with the price level, but the exchange rate here, actually what's in practical happening is not following through as we discussed, right? But you could see some extent that also like sloping towards down, but it's not a parallel one, right? There are so many ups and downs, but you could see, you know, exchange rate also, the yen is appreciating, right? So in a broader perspective, purchasing power parity, yes, it gives some kind of signals, but it doesn't mean you could forecast for next 6 months or next 1 year or next 2 years. No, sometimes it won't be the case. As I just slightly mentioned earlier, the purchasing power parity may not be accurate, right? That means the law of one price may not hold, right? You may not be seeing law of one price in the market due to various reasons. So there are three important reasons you could see. One is trade barriers and non-tradable products. Second one is imperfect competition. And third one is differences in the measures of average price for basket of goods and services. So I have slightly mentioned, anyway, I have given in detail. If you take trade barriers and non-tradable product, right? If you go through an international trade, definitely there's a transportation cost. So when you're going to buy a product from Japan, definitely you will be giving higher price. You cannot say it's law of one price or purchasing power parity in place because of the transportation cost. And there can be government trade restrictions, right? Now, if you want to buy a car, definitely trade restrictions are there. The government can have tax on that. So definitely you don't get and any other, you know, margins and all. It will bring into added cost, right? So definitely you don't get the same price here, right? And in some cases, like you could see non-tradable goods and services, right? Right. So then the second one, services are often not tradable, right? I have given a haircut. So, okay, like you may be spending maybe 500 rupees for or a haircut, right? But if you go to Australia, maybe $60 per haircut, right? So Sri Lanka is very cheaper, maybe in Aussie dollars terms, like Sri Lanka, if you calculate, maybe 8,000 rupees per head, right? So can a person come and have the haircut here? No, right? There's no way to do the haircut, right? So services are often not tradable, right? So then you cannot see a law of one price working on that ground or purchasing power parity, right? You won't see that, right? And then and also you should see, like as I explained, when the transportation cost is higher, right, exchange rate can deviate from its purchasing power parity, right? That's what we discussed earlier. I've given here, it's based on if it's a small change, right, there won't be that much deviation. But if it's a greater change, so then you will have a deviation on the exchange rate as well, right? So due to these reasons, you cannot see one price in two markets, right? So even though theoretically we speak about the one price, law of one price and purchasing power parity, but very difficult to see uh, that kind of availability, right? Price availability. And second item, imperfect competition, right? Now you could say, like, take this textbooks, right? So a lot of textbooks, right? They will be fixing different prices for different market. Now, if you see this Miskin's microeconomic books, maybe in US that might be $100, but if you go to India, there's a separate publication for India, maybe Sri Lanka and Bangladesh. That's very cheap, right? So then they have the different prices for different market, right? So in that kind of pricing or price discrimination, you don't get purchasing parity. It's faulty, right? Even not only books, there are so many products, they're pricing it for market, right? And then finally, differences in the measures of average price for goods and services, right? So now earlier we discussed, okay, you take the price, basket price of US and Canadian basket price, but the problem is our baskets are different, right? It's not with the similar goods, and it's not with the similar weightages. I could see it changes with the policy decisions, right? If you all can remember, like a few years back, or maybe 5, 6, 7 years back, we made a change in the goods of basket. Can you remember, anybody?
Prior to 2015, no, sir? It is prior to 2015? So,
yes. And I could remember, now in Sri Lanka, we removed, I think, during that period, we removed alcohol from the basket, right? Various reasons given. I think one of the reasons for we want to become kind of alcohol free, or we didn't want to promote alcohol, so we don't want to keep that alcohol in the basket. It's one side of the argument. But you also could see in an economic perspective, what are the goods should be in the basket, right? The goods mainly should be like what are the goods you mostly used or mostly spend on, right? So alcohol also one of, like, maybe rental, maybe rice, maybe flour, or like maybe alcohol. So what's happening in the actual economy, you should take those goods, right? So if you remove one goods, so definitely your general price level is going to change. You are going to change the weights, maybe you are going to change the general price level. But in other country, they will be having the same basket. So can you can you put these two buckets together and do the same analysis and same conclusion? No, because we have changed our basket, right? So the goods are matters and weights are matters. Now let's assume like, okay, you are using rice here, maybe 30% weight given to rice, right? In Canada also maybe 30% weight given to rice. But suddenly we say, okay, we don't want to eat the rice, so we bring down the percentage, 20%. But still you may be eating 30% rice, right? So then it's, it will confuse, right? And then it won't sometimes show the actual price level. That's what I want to say, right? I'm just telling an example. If that happens, what will happen to the basket and general price level, right? As an example, right? So then you can see that also one of the issue, shortcomings in purchasing power parity calculation. So if everything's together, there's no trade barriers, no additional cost whatsoever, and like everything is in a perfect market, then definitely law of one price should be prevailing, right? But it's not a ideal situation. It's not going to happen anyway, but for understanding we should have that kind of assumptions, right? Okay, up to now, is it clear? Right. So I think there's no questions, so we can move on to kind of theoretical part. You also should understand. So nominal, so up to now we have seen what is exchange rate and how is that determined. And even though this is determined through purchasing power parity and with the law of one price, right, there can be two kinds of interest rate we will be talking about. One is nominal exchange rate, nominal exchange rate and real exchange rate, right? So it's, when it comes to nominal exchange rate, that is what is available in the market. That is nominal exchange rate, right? But real exchange rate means at which the domestic goods can be exchanged for foreign goods. When you transact with the goods, what would be the rate? That is the real exchange rate. Now let's assume if you give one burger to a US guy, instead of that, okay, in turn, if you get two burger, then it's 2:1. That is the real exchange, right? So nominal exchange is the exchange rate prevailing at the market, quoted in the market. But in a real exchange rate, we talk about based on the goods, right? Okay, see this example here. In New York, you consider a basket of goods that is worth $50, right? The same basket of goods is worth 7,500 yen in Japan, right? So nominal exchange rate is 100. That means $1 is equal to 100 yen. That's a nominal, right? That's a market rate. That means if you want to buy $1 in Japan, you have to pay 100 yen, right? But we have seen the real exchange rate, how many foreign goods you can buy by paying 1 unit of domestic goods, right? So if you could see, we have seen here in the example, same basket, right? So same basket. So what is the price in a nominal exchange rate? That means the $50 worth of goods. So exchange rate is 100. So the worth of this US dollar basket is, right, 5,000. But what's the price is going on? 7,500. Right? So now what is the real exchange rate? You divide this 5,000 by 7,500. That means real exchange rate is 0.66. Right? But nominal, what's the nominal? Anybody? If you want to say in terms of goods, it's a 0.5, right? But real exchange rate, it's 0.66, right? So purchasing power parity predicts that real exchange rate is always equal to 1. That means we studied that, right? So always you are going to have one price. Goods to goods, it's a one price of law of one price, right? So purchasing power parity says, okay, you could be able to buy same goods. So the real exchange rate is, it's always equal to 1. But when we calculate, right, you will get, based on real exchange rate, this goods is worth of, right, 0.66. If you are not clear, just see the example again. You have to keep in mind nominal exchange rate, that is quoted in the market, but real exchange rate, that is we are going to calculate based on the goods exchange. That's a difference. Now here you could see, right, based on the price, relative price, you could see the changes, what's happening over the period. But the exchange rate, it goes ups and down. But the basic price, the base year is 1973, starting with 100, right? You can see the price indices, it's going the relative price, but it's not parallel exchange rate, it's also moving in different directions over the time. Is that okay? I think in your previous discussion, you might have discussed this nominal exchange rates and real. Anybody? Have you all discussed? Not during my discussions, previous discussions. Can you all hear me? Hope you all are hearing and understand. And please stop me and ask questions if you don't understand. Right? This is a kind of practical example, as I discussed earlier. You know, like Big Mac, it is sold everywhere around the world, right? So Economist magazines normally publishes this Big Mac indexed, they call it, right? To see whether this purchasing power parity is explained through that. So these Economist magazines collect this Big Mac index. So every McDonald's in every country, you could see this Big Mac they are selling. So they collect the price and see what's the price, whether this purchasing power parity prevailing across the world. Right, this kind of, you could study that and see. This is an example I just wanted to show you. Is that okay? Now what we are going to see is two different perspectives. Up to now we were talking about, in general terms, it's an exchange rate in general terms. But in an economics view, like you, as always I say, you have two different views. One is long run view and short run view. Right? So in a long run view, always this law of one price should be reached, right? As we discussed earlier, you can have different brands or no, different products. Like take the example pizza, you can have different products, but at a different price, but finally in long run, you will arrive into a one price, because like we discussed, two restaurants, one restaurant sells at $20, another one sells as $40, but finally he has to reduce the price. So that's a long run, right? So finally they should be able to sell the pizza at $20. So long run, if there's no barriers or barriers are very low, then the law of one price will prevail, right? The basic rule when you discuss about the long run exchange rate, the basic rules are anything that increases the demand for domestically produced goods relative to foreign trade goods tend to appreciate the domestic currency. It's a basic rule. Like in a long run, how this exchange rate changes, right? There can be four factors, very important factors, that can influence the long run exchange rates. One is relative price level. We have seen, right? When one country's prices increases compared to other country, that's a relative price, then you will have an impact on long run exchange rate, right? Or trade barriers. If you are going to have a trade barriers, then long run you will have different exchange rate. And preference for domestic versus foreign goods, that means like even there are different prices, right? So you preferred for domestic goods, then if when your preference changes, but earlier we discussed there's no different preference, because same pizza, same taste, everything same, you don't have different preferences, then law of one price prevail. But if you have different preferences compared to domestic versus foreign, then your long run the exchange rate going to be changed. And then productivity. If the local market, as an example, produce more, relatively more than a foreign country, then the local currency will appreciate, because we produce more than foreign country. Right? Okay. So this is the basic rule and how the factors affect the long run exchange rate. So short run, long run are two different things, right? Long run factors are totally different than a short run factors. Short run also, like exchange rate may be affected, but that is because of different factors. Right. Now you have to see, I have given a table, right? When the factors changes, what will happen to the exchange rate? The first one, domestic price level. Just think about Sri Lankan context. When the domestic price level increases, what will happen to a currency, local currency? It depreciates. Right now, you could see, okay, in past history, whenever domestic price level increases, right, you will your currency, the LKR, will depreciate. Right. So then the second, when you have trade barriers, when you increase the trade barriers, what will happen? Your currency will appreciate. Right. When you have trade barriers, more and more trade barriers, then you don't have imports, right? You will have excess foreign currency, right? Comparatively, then your local currency will increase, right? So given, you see, the marks are very important, trade barriers related to other countries, right? Okay. And then import demand. When the import demand increases, what will happen? Your currency will depreciate. Why this? Currently there are so much of restrictions on import, because we won't let our currency to depreciate, right? The currency value should be maintained without much fluctuation. So there would be some restrictions on import. So based on the theory, now you could understand, when the import demand increases, your currency will depreciate. You understand the rationale, right? Because when you import more goods, you need more foreign currency, right? To pay that. So then you go to the market, you sell your rupees and search for dollars, right? So when the demand for dollar is higher, then dollar appreciate, our local currency depreciate, right? Always think about that direction, right? So export demand, when the export demand increases, you'll get more dollar. So in a market, the dollar supply is more, so then our local currency appreciate, right? And then finally, productivity. When you produce more, that means when the productivity increases, you produce at a lower cost, right? So your products are now at a lower cost, then you will be selling at a low price, so there will be a bigger demand for your product, so then your currency will appreciate, because people try to buy our product paying rupee. So demand for rupee will increase, so then your currency will appreciate, local currency will appreciate, right? So just for understanding, wherever I used here dollar, it's a textbooks example, so then you should think as a local currency, right? So just take this text and put it Sri Lankan context and read, because like always our mindset is dollar is, foreign currency, right? So sometimes when you read, you tend to think dollar is a foreign currency, but carefully read the examples what I have given here. That's dollar seems to be a local currency, because it's a textbook's example, right? Not a local currency and local macroeconomic example, right? Sometimes that kind of questions I came across in the past, not this class but previous classes. So basically try to understand, whenever I say dollar, right, So unless specifically mention LKR or like foreign currency, it's most of the time it's a local currency, right? Is there any questions in long run scenario?
So here this productivity refers to productivity on production, no, sir?
Not production actually, it's a productivity. And now production and productivity are two different things. Now production, okay, you have a factory, you have 10 employees, you produce 100 kilos of rice or 100 shirts, right? That's your production, right? So your cost, maybe one shirt is 100 rupees cost, right? So 10 employees produce 100 shirts. But if you put another 10 employees, 20 employees, if you produce 200 shirts, still your cost is same. Your production increased, but your cost is same, right? But productivity means you still having the 10 employees, but now you are not producing 100, you are producing 120. So that means your productivity has increased. Now your shirt cost is less than the previous one. So when the cost is less, now this US market, the people from US, they try to buy your shirt because your cost is less and you are going to sell at a lower price. So there's a demand for rupee because they have to pay in rupee because it's produced in Sri Lanka, a Sri Lankan product. So they are going to pay in rupee. So they sell their dollar, they are ready to sell their dollar and buy rupee. So demand for rupees increases more now because of the productivity. So when the demand for rupee increases more compared to the previous time, so then your currency, local currency appreciates. Is it clear?
Yes, please, sir. Thank you.
Okay. If there's no question on long run, so see the short run. So long run factors, you know, relative price levels, trade barriers, and preferences. Why we are saying long run? Because relative prices never change in a short period. Trade barriers not coming in very short period. Preferences never change in short period, right? Over the time only you change your preferences. And productivity, you don't get it overnight, right? So that's what it's always a long run factors, right? But short run, what will happen to exchange rate in short run? That is basically a foreign exchange market phenomenon. What's happening in the supply and demand in foreign exchange market? There is a short run analysis, right? So now in a short run, how is exchange rate is determined? The exchange rate determined based on the price of domestic assets in terms of foreign assets, right? It's based on the demand and supply between domestic assets and foreign assets, right? So assume the supply curve for domestic assets is fixed, right? I can show you the picture. I'll go back to this picture and we can discuss again back to the previous slides, right? Now in this picture, you can see in this graph, the y-axis, this exchange rate, euro to dollar. right? So quantity of dollar assets, right? So here you should see, this is the problem always in this charts. When we say quantity of dollar assets, it's not the foreign assets I am talking about. It's the domestic assets. Keep in mind, because this textbooks is from US, right? When they say dollar assets, it's a domestic assets they are talking about. Okay, so domestic assets, quantity of domestic assets is fixed, right? S. So now it's a demand for domestic assets. Right? Okay. Now you could see excess demand at EC, excess demand for the domestic assets, causes the value of the dollar to rise. Right? Now let's assume, okay, now you take Sri Lanka as an example. Now you have a financial instruments, or maybe bond you are going to give. It's a financial assets I am talking about, for an example, right? You are going to sell it, right? So foreigners willing to buy that, they demand more, right? So when they demand more, what will happen? They need now our currency, right? So they demand more, this bond. What will happen? Automatically, the Sri Lankan rupee will appreciate. So the exchange rate will go up. So when it comes to excess supply, you have more bonds, but nobody is buying. Then what will happen? Automatically, your currency will maybe from EA to E is depreciated. Right? Clear? So it's basically what is in your market, right? The foreign exchange might be determined based on the supply and demand for the domestic assets. Is it clear? So if you see the supply curve for domestic assets, that's fixed, right? Okay, this is what is available in the market. But what will happen to the demand, right? So various exchange rate, you will have various demands, right? At EA, you will have excess supply, A to S, this part. But EC, you will have excess demand, right? This is the domestic supply. This is the domestic asset supply and domestic assets demand. So exchange rate in short run, it would be determined like this. Is it clear? So you have to think in long run, it's various factors that it's a long run factors that will affect the long run exchange rate, right? So if there's any no other restrictions, in a long run, you will get a law of one price or purchasing power parity prevail in a long run. But short run, it's determined by the supply and demand of your domestic assets. Okay.
So excuse me, why this supply is constant always in the short run?
Sorry?
Why the supply is treated as constant?
Yeah, because now supply is not relevant to the exchange rate. You don't issue the bond based on the exchange rate. Now here we are taking only two variables, right? Exchange rate and quantity of dollar assets. Now let's assume now government is going to issue the bond. So government, when the government issue the bond, that depends on the financial needs of the government. It's not depending on the exchange rate. So whatever the exchange rate, government is going to have, okay, $5 billion bond. They are going to stick into $5 billion bond, whatever the exchange rate. But demand for that bond will be based on the exchange rate. Now foreigners will look at our exchange rate, right? Dollar to rupee exchange rate, and they will calculate the return and see whether their return is sufficient for this investment. So then demand might be changing, but the supply is fixed because that is not depend on the exchange rate. That is depends on the deficit of government. So it's depends on other factors. Here, whenever like we draw a chart, we are going to see the relationship between these two variables, not other variables. Is it fair? You got it?
It's fair enough, sir. Yeah, I got it.
Okay, okay. Okay, now, as I said earlier, I explained, okay, domestic assets, that shift in the demand for domestic assets may be depending on domestic interest rate and foreign interest rate and expected future exchange rate. Here I'm talking about the shift in the demand, right? Earlier I was explaining the demand moving along with this curve, that is depends on exchange rate. But here I am not talking about the demand point moving along with the curve. Here I am just stating that shifting the demand curve. Now what will happen? The demand curve shift. What are the factors going to shift this demand curve? That can be, one is domestic interest rate, and second may be foreign interest rate, third may be expected future exchange rate. So the factors other than this exchange rate would shift this demand curve, right? So not the exchange rate. This is, we are telling here, expected future exchange rate, right? You should be able to understand that. Okay, let's see based on this graph how that works. Now, response to an increase in the domestic interest rate. Okay, now let's assume the domestic interest rates are increasing. So what will happen to the dollar assets, right? So now everybody would be thinking, okay, interest rate increasing, right? So it's a time to buy, because now increasing, it's always like, okay, when I say domestic interest rate, you are going to compare with the foreign interest rate, right? Okay, so now domestic, when the domestic interest rate increasing, the foreigners would see, okay, I'm going to get better rate, right? So they think, okay, our bond will be with added interest rate now, right? So interest rate increase, so that means bond will be having more interest rate now. They will get more return. So then there will be a more demand for our dollar assets, right? So demand curve will shift outward, right? So when the demand curve shift outside, right, that means the central, the government has issued maybe dollar bond, right? So everybody, rupee bond, everybody trying to buy that because everybody thinks, okay, it's a better interest rate. Then automatically what will happen? Exchange rate appreciates. from 1 to 2, E1 to E2. So we should think, okay, when the domestic interest rate increases, right, the demand will increase for the domestic assets, and then your exchange rate will appreciate. So please consider again, always remember other factors constant. I'm not talking about other factors. When you bring other factors, then this will not be the case. So always think about, I am talking about only the change is the domestic interest rate increases, nothing else. Most of the questions, most of the time you will get confused if you bring other factors. What will happen to the example, if I say, what will happen to the inflation when the domestic interest rate increases? So when the inflation increases, what will happen? So it's so many factors we are not going to, you are going to consider. No, we have to consider only one factor, that's increase in the domestic interest rate. So what will happen to your exchange rate? That's it. Right? Okay.
Small things, sir. Sorry to disturb you again and again.
No, that's fine. That's what I wanted.
If you go back to the previous slide.
Okay.
So when interest rate increases in a domestic scenario, that means bond prices will go down. No, sir? Will it what do you call, attract foreign investors to buy the bonds or treasury bills? That's how it works.
Now, when the okay, you're talking about the value of the bond, right?
Yes.
Now,
yes. So it definitely it will have a direct impact on value of the bond, no, sir? Especially
exactly. So yeah. So then what will happen? They will get a more return, right? That's the point I'm making here. Now, two things. When the domestic interest rate increases, now earlier the bond was sold at maybe 100 rupees. Now it's 80 rupees, right? So investor is going to have better return. So they will increase the demand for bond. So then exchange rate will increase. That's one point. And sometimes, right, on the other hand, if it is a newly issued bond, if you are going to issue a bond, when the domestic interest rate increases, definitely the new bond will be at an increased interest rate. So through interest rate, also they will get a better return. Right? You are talking about the already existing bond, one, and the new bond. So whatever the case, the foreigner will increase the demand, because now they are getting better return than previous. When they started to increase their demand, market will, correct itself through the exchange rate. So exchange rate will appreciate, because so many people are trying to buy our local assets. Is it clear?
Clear, sir. Yeah. Yes, clear.
Okay. Okay. The second, foreign interest rate. Response to an increase in a foreign interest rate. What will happen when the foreign interest rate increases? Now the investors, like earlier scenario, investors goes to foreign assets, not the domestic assets. So the preference now shifted from domestic assets to foreign assets. So everybody moving, okay, maybe selling our, now if the current, like previous scenario, if you see, the foreign investors like switch their investment, maybe from Sri Lanka to other countries, right? Wherever they get better return, right? Sometimes even if you get a better return, sometimes the risk factor works other way around, right? Sri Lankan sovereign bond, I think that was sold maybe 60% cut. Yeah, I think listed one in Singapore, 60% cut. So because of the risk factor, but if somebody is going to buy at 60% cut, he is going to like get a big return. Nobody else will get. But even though the one or two the cut listed there, but nobody was selling at that rate. Yeah. So then the people will be moving from one bond to other bond, right? So now when the foreign interest rate increases, they will be having better return from the foreign bond. So then they will maybe less demand for domestic assets, or like they will sell and go. So in whatever the ways, there will be a less demand, right? When the demand is less, right, our currency will depreciate. Even if they want to sell it, even they will try to pull the dollar out. So there will be more pressure in the market, foreign exchange market, and the rupee will depreciate. Is that clear? And then increase in the expected future exchange rate. If people think there will be a appreciation, so expected future exchange rate increases. Now you are an investor. Today the $1 is 200 rupees, right? If you think Sri Lankan rupee will appreciate, right? You demand more, right? You can see a rise in the expected future exchange rate, shift the demand curve to the right, right? So when you demand more, the exchange rate will appreciate in short run, right? Because it's an expectation. You put it today itself, but you are thinking it will be future phenomena, but you based on that, you today itself increase your demand. So in short run, the exchange rate may appreciate, but we don't know what will happen in the future. It's a future expectation. But short run, you will have an appreciation, but long run again you can have depreciation, because if it is not happening, all macroeconomic fundamentals are working together towards our expectation. If not, then it may be other way around. But for short run, you will have a appreciation because you think there will be a appreciation in the future. So you wanted to do the transaction today itself. Is it okay?
Here's an increase in exchange rate means improvement in exchange rate, or the next decrease in exchange rate.
Here, I think, yes, you have to always think about when we say increase, that's appreciation we are talking about. When we say decrease, it's a depreciation we are talking about. Clear?
Clear, sir. It can work other way around.
Yeah. That's what the confuse may come if you see the amount, right? Plug the amount and see. So sometimes we miss it, right? So immediately when you say increase, that means appreciation. So decrease means depreciation. You think in that way. Good point. And then I think everything is put it together here for your understanding. Maybe I hope it may be clear for you as well. Factors that shift the demand curve for domestic assets and affect the exchange rate, right? Everything is given here. Changes in quantity demanded of domestic assets at right at each exchange rate. You could see change in factor and response of the exchange rate. As we discussed earlier, what will happen to the, it's a summary picture. If you can understand this one, I think you are through. It's domestic interest rate is given, foreign interest rate is given, expected domestic price level, expected trade barriers, expected import demand, expected export demand, and expected productivity, right? Just see this. If you have any problem, even just you have exam on 19, right? If you have any doubts, you can email to me, right? We can see this is already discussed, but I have put it together based on the textbooks, so you at a glance you can see the differences or what's happening. As we discussed earlier, this application part I have given you for understanding. If you read some example, you can see what will happen to the exchange rate, right? Okay, just have a idea on that. I'm not going to discuss that because already discussed. And then now, up to now, two things we have seen. One is the exchange rate itself and how that determine purchasing power parity, low of one price, and in a market scenario, short run and long run, what will happen to the exchange rate, right? And now I'm just going to discuss about the foreign exchange markets, right? Into that, there may be some additional information for you, right? As we know, if you take the foreign exchange market, it's not a kind of a physical market where you buy goods and services or stocks. It's just a call, right? If you see banks in between, if a like maybe Citibank call to Standard Chartered Bank to get just a call and get for 10K or 100K, so then it's $100,000, right? Just a deal, right? So there's no physical marketplace. Over the phone they do the deal. It's everywhere, it's around the globe, right? No physical marketplace, just anything can be. And then the most trades, right, they use Swift for messaging, right? It's a very secured messaging technology, right? Society for Worldwide Interbank Financial Telecommunication, that's what Swift called, right? Still the market players are using this Swift, but there's another project, because like even just for an understanding, you can have your treasury, if they want to make a deal with other Sri Lankan bank or City to Center bank, still they use Swift message, so that will go to Singapore and come back, right? You have to pay for that. So there's a project, okay, we can have our own messaging system, so you don't need to pay for third party, you can have within Sri Lanka. So that kind of ideas are in pipeline, right? So basically, as I said, even though you make a call, finally you have to send the message to confirm your deal and make the deal happen, right? I always talk about this OTC, over the counter market, right? You can do foreign exchange transaction over the counter. That is the biggest market, over the counter market, because every time it happens over the counter, right? And also you should understand it's 24/7, right? Market. That's what we say, sleepless market, right? Because like in Sri Lanka it may be day, in US it may be night, but still markets are working. That's the beauty of this market, because even a fraction of second the rate changes, and it's very difficult to get benefit out of the price differences or exchange rate differences, right? If it is other good market, you can buy, okay, if you can buy vegetable from Dambulla market and sell it in a Colombo market at a different price, right? But in a foreign exchange market, you cannot do that, because within a fraction of second, even though there are differences in the codes, right, immediately that would settle, right? So that's what it's always active market. As I explained earlier, the types of forex markets that can be spot and forward. In Sri Lanka, the most of the spot market is the participants are from commercial banks, brokers, or customers of commercial, and even central bank. They also intervene, or if they want, they buy or sell it, right? This is a very low risk market. Why we say? Because settlement happens immediately. There's no counterparty risk. You give me dollar, I'll give you the local currency. So settlement is done. There's no very low risk, right? Okay. But in a forward market, the players can be arbitrageurs or traders or hedgers or speculators. 4 kinds of players involved in this forward market, right? If you see arbitrageurs, right? So arbitrageurs means, okay, they do trading, foreign exchange trading, in a risk-free manner, right? Okay. Now they would be looking at the price differences, as I said. What do you mean by price or rate differences? Now here, if you think about our cross-currency rates, now there can be 2 rates. It's there, right? Are listed. You could see. But same time, third currency, right? Rates, not like people may not be knowing those rates, right? Maybe some countries, maybe take it as like, okay, some African countries rates are not readily available, right? But what you can do is, right, you buy through various currencies and then sell it and buy it and sell it. Finally you will end up with small profit margin. That also for small period you will get that, because immediately that market differences will be rectified, right? That is called arbitrages. They don't take any risk. They will do back-to-back transactions, right? So then they don't lose, right? They make small profit, but when the amounts goes very big, the profit can be sometimes significant. If you could see this example, I have given here three exchange rates, 3 pairs, right? First one is EUR USD, second EUR GBP, and GBP USD, right? You have these exchange rates, right? Okay, just I'm not going to, because there's no boards and all, I'm not going to write and calculate and show you, right? So just step by step I explain. If you want, you work it out and see, right? So, and finally you will arrive at a answer or profit, how these arbitrages get the profit out of these small differences. Now this is the exchange rate at the market, right? So first, a forex trader could buy one mini lot of EUR, right? So euro they can buy mini lot, in the sense it's the name given for 10k, right? 10,000 means it's a mini lot, right? So 10,000 euro one trader can buy at a price of 11,837 dollars. Now you could see the first one, EUR USD, Euro USD rate is what? 1.1837. So if somebody wants to buy 10,000 euro, right? So they have to pay 1.1837 rate. That means 11,837 USD. Now we bought 10,000 euro. Okay. Now the trader could sell 10,000 euros for 7,231 pounds. How? Because Euro GBP exchange rate is 0.7231. So if the trader sells his euro already bought, he can get 7,231 British pounds. Right? Then what we can do is again sell this British pounds. That means 7,231 to USD. So if you take this third exchange rate, GBP USD, right, that is 1.6388, right? So now, if we can sell this GBP to USD, he will get 11,850, right? Because the rate is now 1.6388 for GBP USD. So now finally, he got, earlier he spent how much? $11,837, but finally he got $11,850. That means he made a $13 profit. Within a fraction of a second, you do all these three transactions and finally you got $13 per trade. That is for 10,000. If you make it 100,000 US dollar, so your profit might be 130. This was people like all around the country, these forex traders sitting in front of the computer say, oh, you can't do it Sri Lanka, but there are countries that is allowed forex trading, right? Their job is to day and night sit in front of the computer and find any price differences, rate differences, and work out quickly and make the profit, right? So this is called forex traders. Like country to country it differs. Some countries relaxed, some countries highly restricted. So a forex trader can make a profit. It's a risk-free trading. So those kind of people we call arbitrators. They do arbitrarily this transaction and quickly. But you have to remember one thing. Within a second, these price differences would be rectified, or it correct itself, right? You can't find the price differences for so long, maybe a few seconds. You have to make a deal. So when you do this transaction, you suddenly maybe the prices or exchange rate may be different. Sometimes you may be making losses as well. It's up to you, right? It's your luck. Okay, so then first parties, players, we can call arbitrators. The second may be traders, right? It's as usual. We normally, right? You could see the traders, they trade currencies from different countries against each other, right? They buy and sell, not doing for like, you know, not for price differences. For need, they try and sell, right? So if you want to have a dollar, you can buy it. Or if you want to sell, you can sell it. Right? If somebody like, okay, forget it out, like your local currency. Now you buy USD and sell GBP. Right? So now you get GBP. When you sell USD simultaneously, so what we used to say is you are long in GBP, right? Your position is long. That means plus means long, minus means short, right? These are the words used in a trading desk, right? So they buy and sell. So long in USD, short in BBP. So these are the words they use to it. But fine, you have to understand what you have to understand is like, okay, a trader can buy and sell currencies simultaneously, and he can end up with a long or short with currencies. It's normally happens through broker or market maker, right? The difference between broker and market maker, anybody? What's the difference? What is mean by market maker? Okay, market maker means they will quote both rates. Buying rate, if you take a bank, they will quote buying rate for USD as well as selling rate for USD. Whoever like quoting both rates, they are the market makers, right? So they will give you the corridor, right? So what's the buying price or what's the selling rate? So we call them as market maker. So they are the people deal with buying and selling, so making a market, right? Okay, this is traders. Next party is hedgers. Now let's assume now you have 10,000 US dollars. When you have 10,000 US dollars, take as in bank, okay, they have 10,000 US dollars. Now you are long on US dollars. That means your assets is plus US dollars. If you're confused, if I want to go further, now take a balance sheet, right? You have US dollar balance sheet or cash flow. Take it cash flow. Now you have inflows and you have outflows. That means you have assets, you have liabilities. You put all your USD assets, maybe currency, maybe some bonds, you put it everything together. And there may be some liabilities, right? Maybe deposits, right? If you deduct, right, as an example, if you deduct your liabilities from your assets, if you get a positive figure, that means your assets are more than your liabilities, you are long in USD. But your liabilities are higher than your dollar assets, dollar liabilities are higher than your dollar assets, then you are in short, right? Now that is we call net open position, right? If you have an open position, are you running at a risk or not? Any thoughts?
Since we have dollars, I think our position is much more better. So that's what I think.
Sorry, I didn't get you.
Since we are having a surplus of dollars compared to the liabilities that we have,
Okay.
so I think our position is much more better. So I think it's much more less risky.
Okay. Anybody else? Okay, if you have an open position, you are saying, okay, when you have more assets, right, you are better. But you think of a scenario, you may be correct one side, but there can be other scenario. Let's assume you have open position or long, right? So then let's see your currency, local currency. Okay, you have $10, $10,000 open position, long position. Now your currency, like exchange rate, may be $1, 100 rupees. Now the local currency appreciate. Now it's 80 rupees. Now if you take this $10, that is your $10,000, that's your assets. If you are going to convert your $10,000, how much you get? Earlier it was 100 rupees, so 10,000 into 100, you get 1 million if you convert. But today, if you are going to convert it, it's now 80 rupees. So then you can get only 800,000. So now, even though you have the plus long position, you are going to lose 200,000 rupees when the currency appreciate. But if the currency depreciate, if that goes from 100 to 120, then you will get 200,000 surplus. So it's a matter of fluctuation on the exchange rate, not the matter of. Can you hear me? I think so. Okay. So it's not the matter of exchange. It's a matter of exchange rate, not the matter of position. You can have plus or long position, but when the currency appreciate, you are going to lose. But if you have a short position, when the currency appreciate, your liability will be less now. Because in local, you can buy at 80 rupees and settle that. Now you are more good. So now, even though you can have short position, long position, the matter is which way the exchange rate is going to move, which side. It's a depreciation or appreciation. If you long position, appreciation is risky. If it is a short position, depreciation is risky. Right? So now the problem is, now we know, even if you have whether short or long, if you have a position, open position, that is risky. It can be short or it can be long. That is risky. So we also we always ask banks, okay, you can carry open position as much as you can carry. You can absorb the losses. But you should have some mechanism to mitigate them. So then some banks, what they do is, they do back-to-back hedging. A hedging is like an insurance. Now, if you have 10,000 open position, they make a deal, right? So back-to-back with other counterparty, right? to sell as well. Now that is square. That means now liability, US dollar liabilities increases by 10,000. Now the liabilities and assets might be equal. So you will have another contract that is called hedging contract. So now you make this position square. Square position means no net open position. So whoever doing that kind of hedging activities called hedgers, right? So in banks, normally the carrying an open position is risky, but still they can carry to make, you know, profit or loss. It's based on their business model, but we encourage to have mitigants in their place, right? So like big amounts, they don't keep it, so they do back-to-back hedges. Even foreign banks, most of the foreign banks in their policies, it's there. They have to do back-to-back hedges, right? If somebody is going to buy dollar from that bank, they will be simultaneously selling dollar. So then their dollar position is zero. You got my point? Now, if a customer is going to sell $100,000 to bank, that means bank is buying $100,000. What will bank do? Similarly, in world market, right? Or with their counterparties, right? With their head office, with their regional office, they sell that again. So they are not running a position there. They buy the dollar and sell it already simultaneously. They make the profit out of that. They buy at a lower rate and sell at a little bit higher rate. They just make a profit, right? That's a buying and selling, right? So if a customer, you have a $10,000, if you want to make a hedge, they will do the hedging for you. You have to pay a premium and they will make a hedging. Right? Now you could call, recall the oil hedging. That's also similar, right? Similar hedging arrangements. That is for oil prices, right? So something like that. Now you go for a hedging to minimize your risk in unnecessary fluctuation in the exchange rate. So those kind of players we call hedgers. So direct hedge, as I said, simultaneously you are going to hedge it, right? Buy and sell the same pair. And then speculators, this some people burn their fingers through this. They speculate, right? They buy and sell currencies. Actually, in reality, they don't deliver, right? They speculate, and based on the movement, they try to make profit, right? So one hand, they try to buy a dollar, another hand, they buy to sell it, right? They speculate, okay, rate will be like this. You go for a forward contract, 3 months contract, you buy at a rate and sell at a rate, right? Try to get it. But sometime it's not going to work as you think. Okay, you bought some currency today and just planning to buy, you know, after some time, but market will go in a different way. But Sri Lanka, there's no space for speculation. Always there should be underlying transactions, right? If we allow this speculation, what will happen? You know what will happen, right? In the market, everybody just think about the direction and try to speculate, right? So you cannot control the market, right? That can be a disaster, right? So these four kind of players we discussed: arbitrageurs, traders, hedgers, and speculators, right? In a foreign exchange market, so the exchange rate can be, passing through these players and can be manipulated as well. That's what you should be able to understand, and the risk involving in this kind of transactions. Is that clear up to now? Okay, now we have seen the players and markets. Now next, what we are going to see is what will happen when we conduct a monetary policy, or when a central bank intervene in the foreign exchange market, right? So what will happen to the foreign exchange rate? What will happen in the money supply when central bank intervene for various reasons? I think last class we discussed in detail about conducting monetary policy, money supply, and central bank roles, and what would be the impact on the economy. I hope like everybody listened to at least the recording, right? Whoever not in the class, right? So now this point, I'm just going to link this monetary policy activities with this foreign exchange market, right? Okay, if you now we have discussed the central bank balance sheet and how that works and what are the items on the central bank balance sheet, right? We have discussed already. When a central bank intervene, right? Intervene can be different ways, right? So one, central bank sell its foreign assets, right? Okay, now central bank issue the currencies. I just anyway recall it. Sell the issue the currencies. When central bank issues the currencies, its liabilities increases, right? I hope you could remember, right? So now let's assume, okay, now in the market, take Sri Lanka as an example, right? Now there's a shortage in the market. Everybody is demanding foreign currency, dollar, right? No banks, or banks are running short of dollar. What central bank should do? Central bank has foreign reserve. Nowadays it's a hot topic. You can see in detail. Central bank has foreign reserve, so they have to sell that. Now let's say $1 billion the central bank should sell to the market. So the $1 billion central bank will issue the dollar and then buy rupee, get the rupee, right? Whoever going to buy dollar, they are going to pay by rupee. So rupee comes in, right? When the rupee comes in, the central bank liability now reduced by 1 billion, because already issued currency, think like that, coming into central bank. So liability decreases. Similarly, foreign assets, that means dollars central bank has already sold, so then foreign assets decreases. This is one part. When the buyer of the foreign currency pay by currency, yes, your liability decreases. But buyer of the foreign assets can, if a bank, okay, somebody is having deposits with central bank, that means reserves, right? They can pay through the reserve. Then the deposit will come down or reserve will decline. So one of these two ways a central bank can intervene in the foreign exchange market and sell the dollar and get the currency in, or like they can reduce the reserves. So if they do like this, what will happen in the money supply? Central bank sold the foreign currency and get the currency back or reduce the reserve. What will happen to the money supply? Money supply now decline. Is it clear? I hope it's clear. Anybody understand, please, even if it is not in the last lectures, we can ask question. If you haven't listened yet, of course, you can ask even basic questions, no issue, because this is very important. Out of this all discussion, these are the very important discussion, not only exam perspective, but also as a banker, you should be able to understand the market scenarios, right? Any question? Okay, now it can be other way around as well. Now here you can see I have given that as well. Now this is selling US dollar we have seen, and sometimes the market, foreign exchange market, contains excess dollar. They are also the central bank should intervene. Now if you take China, the Chinese central bank, People's Bank of China, they buy from the market, right? So when they buy from the market, you will get assets, foreign assets, additional assets in the balance sheet, and also you have to issue currency or increase the reserve. Your monetary base will increase, right? Okay. Now some people talk about, okay, you print money based on your foreign assets. So many explanations are there, but this is the reality. You know, when you like do the transaction, that's automatically happens, right? When you get the foreign assets, yes, your liability, either way you have to increase, right? Otherwise you cannot intervene, right? Any question? Okay, now we call it a name, that is, we call it unsterilized foreign exchange intervention, right? What is mean by that? So we know now what is intervention. If central bank wants to buy or sell dollar to control the rates, that's an intervention, right? So they can buy or they can sell, right? Dollar, that's an intervention. But this can be unsterilised foreign exchange intervention or sterilized intervention. What is mean by unsterilised foreign exchange intervention? The unsterilised foreign exchange intervention means the domestic currency is sold to purchase foreign assets. right? So what will happen? As we discussed, the money supply increases. Earlier we saw, right? So when the money supply increases, what will happen? The domestic currency depreciates. This is unsterilized. That means when you buy, right, foreign assets, you will give local currency, then automatically in this picture, right, you give through local currency, then what will happen? Your money supply will increase. If you keep as it is, then your currency will depreciate. This is unsterilized. So if central bank wants to restrict that or prevent that depreciation of the currency, what they can do? Anybody? They have to stop depreciation. So they have to control money supply. So through open market operation, what they can do, they can mop up the excess money supply. That means they can issue bond and get the money back. Clear? So that's what central bank, now based on their expectation, they can intervene through unsterilized foreign exchange intervention or sterilized foreign exchange intervention. So when it comes to sterilized, okay, they will be having both transactions, right? So they can sell, right? Or they can buy foreign currency, and then in turn you can give the currency, and then currency is too much, money supply increases, they can move up through open market operation. So now you will have foreign assets in your asset size, and you have, right, liability sides, you can have bond liability. Is that okay? I think, like, if you haven't listened yesterday's lecture, you might be having some kind of confusion. So, one side you should think about how to manipulate the money supply through open market operation. We discussed that, right? And other side, how we are going to play with the foreign exchange market. Now central bank will put together, right, open market operations as well as this foreign exchange market intervention, and do whatever they want and prevent the local currency depreciation. I hope you understand, and if you don't understand, please raise your hands, right, here through Google Meet, so then I can listen to you, or you can raise your questions, right? Now you could see from this graph, right? So again, the y-axis is exchange rate, and x-axis quantity of dollar assets, right? Okay, step one, a purchase of dollar decreases the monetary base and the money supply, right? Raising domestic interest rate and shifting a demand curve to the right to D2, right? So when you purchase dollars, what will happen? Can you hear me?
We can hear you, sir. We can hear you.
Yes, you all understand, right? When you purchase of dollar, that means I always tell you this is the domestic currency I'm talking about, right? You have to switch your mind in between this slide or like text and our local practical example, right? Now, when I say like purchase of dollar, like Federal Reserve Bank, Central Bank of US purchase the dollars, right? So that means decrease the money supply. That means monetary base, like they have issued already currency, then now they purchase, so those currencies are coming in. That means liabilities reduced, right? Monetary basis decline, right? So and the money supply, monetary base and the money supply, raising domestic interest rate. Now you have less money supply. What will happen? So you have less money supply, so automatically your interest rate increases, right? Now everybody demand for your domestic asset. So domestic asset, because now you are short, right? Domestic asset, demand for domestic assets increases, so it goes from D1 to D2. So now your exchange rate appreciates. That is basically when you mop up your rupee, that means when you reduce the money supply, right? Now comparatively, you have less money supply compared to previous money supply compared to the dollar, right? So automatically your currency will appreciate.
So will it work the other way around? Can't we work it other way around? Like since the money supply is low, there is a shortage in domestic money to purchase dollars. So if central bank gets the money back, that means the stock of rupee to buy dollars will be low. So uh, will it lead to an increase in dollar to rupee exchange rate?
That means that is not the appreciation, that is depreciation, if I understood your question correctly. Right? Here.
But yes, sir, but ultimately we want to know what is happening to demand, right?
Yes.
Demand, but is the money is the rupees is not there in the market, so of course there'll be kind of a competition of the market forces. Definitely the exchange rate will go up because dollars are there but rupees are not there.
Yes. Yeah, you're right, but your question is not clear for me. Still you have a question, or?
Yes, sir. But sir, will it? How does it lead to appreciation rupees, sir? So I think it is. Yeah. Sorry, appreciation rupees. Yes, appreciation rupees.
Okay. Now here, here we are talking about the US dollar, right? That means equal to rupee. This is the, again, I just bring it again. Sometimes it's confused. Okay. Now here, I'm talking about the US dollar with regard to Federal Reserve. For them, US dollar is local currency. So I'm talking about the local currency, right? So now, when the Federal Reserve purchase the dollar, what will happen? They mop up the dollar from the, that means local currency, to their central bank. Then now its liability is less, minus, so then monetary base and the money supply decline. Is that okay? That clear? Right? Now, when the money supply is less, right? So automatically, you will have rising interest rate. Why? Because domestic assets is less now, right? Money supply. So somebody wants to have money, now it's less. Then what will happen? Domestic interest rate will go up if you are going to buy domestic assets because you don't have money, less money, right? So now what will happen? When the interest rate goes up, the return, as we discussed earlier, it's now better return. People are going to get out of that. So then the demand for dollar asset, that means local currency assets, will go up. That's what the shift is from left to right, D1 to D2. What will happen? So local currency appreciate. When I say dollar here, it's a local currency. This is the US market we are talking about. If you take Sri Lanka Central Bank purchase LKR from the market. So when they get the LKR into the central bank, money supply decline, or monetary base and money supply decline. So when the money supply is decline, so now we could remember like credit creations and all these stories. Now it's very difficult to get the money from the market, think like that. So then interest rate will go up, local interest rate. When the local interest rate goes up, we discussed earlier, right? So investors, that will give better return. Then the investors will demand more LKR assets, LKR bond. Right? If it's a foreigner wanted to buy LKR bond, then he will bring US dollar, like more demand, more dollar. So then our local currency will appreciate. Now, if central bank wants to prevent that appreciation, what they have to do is parallelly, they have to conduct open market operations and buy treasury bills or bonds from the market and issue the currency. So one side we are getting the currency or LKR in, other side we are pumping the LKR out. So then the position would be scarce, so there won't be any appreciation. That is serialized intervention. Now in the picture, you would see unserialized intervention. I hope like
when there is a such a situation, when you the situation that you explained now, the interest rate is the factor that determines the demand for rupee and dollar, and it leads to a appreciation of the currency.
yes.
Got it, sir. Now got it.
Yeah. Okay, now this is the serialized one I have given in the table. Now earlier you can compare this and this now, right? It's unserialized. You lose your foreign assets as well as your liabilities less now. But now serialized, you see, now nothing will happen to the monetary base. Sorry, through the open market operations, you get the government bond and you issue the money back. So nothing changed in the monetary base. What you have changing is you sell the assets, foreign assets, right? Foreign reserve, right? Dollars, and get the government bonds back. This will happen, right? So central bank can control money supply and limit the appreciation or depreciation through open market operation. Right? So that's what I have given here. To counter the effect of the foreign exchange intervention, the central bank can conduct an offsetting open market operation. So then there is no effect on the monetary base and no effect on the exchange rate. Right? Otherwise, what will happen? There will be a central bank. This is what central bank now. One is central bank before intervention. Okay. Now let's assume in a practical sense, central bank looking at the market. Every day there's a monitoring system. So like the market liquidity is assessed and the bank should inform central bank, these are their inflows, these are their outflows, these are their assets, and these are their liabilities. Everything should be informed. There are cut-off time, they will inform to central bank. So based on the analysis, they will the central bank will see, okay, is there any shortage in the market? If there is any excess in the market, if you allow this shortage, what will happen to the exchange rate? If you allow this excess, what will happen to the exchange rate? So exchange based on the shortage and exchange rate excess, the exchange rate is going to fluctuate. So what central bank will do? See the shortages. Okay, this is a shortage. So central bank is going to intervene that. So sell some dollars and square the position. But when they sell, what will happen? They will get the money back, LKR back. So that will again have a problem. So they can have open market operation and then get the money go out and then get the bond. If it is other way around, so every day throughout the every seconds, central bank will be monitoring the market liquidity and they will be thinking what to do next. Okay, so how we can issue the dollars, right? Basically, maybe okay, give some dollars to Bank of Sloan. Let them issue the dollars to the market, right? Or let's be absorbed through banks, or we will issue bonds. It's a like very quick decision, right? And prevent any fluctuation, because you can't have a foreign exchange market that fluctuates every time, right? So 115, 113, 116, you cannot do that, right? So this is the way central bank intervene. Now there are so many insight, for intervention. Now, like theoretically, I think I have explained to you how that works. Okay, up to now, is it clear? This is the market intervention, and how to conduct monetary open market operations to manage this exchange rate as well. And if it is okay, hold on for a while. I think I have to rush through. Just see. Okay, next part is balance of payment. Okay, next part is balance of payment. I just explained the overall aspect of this. Balance of payment is the kind of bookkeeping system, where you account for inflows and outflows of foreign assets, right? Or foreign funds, right? It give you, right, inflows and outflows, and finally it's a kind of 1 year account, your kind of cash flow accounts you manage. Finally it says, okay, what would be the deficits or surplus, and that is always balanced, right? So there will be two accounts, major accounts. One is current account, other one is capital accounts. When it comes to current account, these are the accounts carrying normal day-to-day transactions or buying goods and services or trades like that. When you tally the current accounts, you will get the trade balance, right? So trade, it can be trade deficits or trade surplus, right? Capital account, it accounts for capital transaction, right? So when it comes to the final figure, right, that will be the balance of foreign reserve, right? Every year, if you earn more positive inflow, then that will be added to the your reserve, right? That is balance of payment. And I have given some stories about US current account deficit, whether it's good or bad and how that happens. You can just read and understand, right? And also I have given 3 regimes when it comes to foreign exchange. So like an international finance system, you can have 3 regimes. One is fixed exchange rate, other one is floating exchange rate, other one is managed float regime, right? So fixed exchange rate means you fixed $1 is equal to 15 rupees. You fixed, right? We call it peg, right? You peg to other currency, you have to maintain always. It's very difficult, right? Second regime is in a country, there are countries they peg, right? And other one is floating. You just leave it to market. Market will decide the exchange rate. That we call floating exchange rate regime. Third, managed float. We call it dirty float. You will let them float, but you intervene. But in Sri Lanka, it's kind of managed float. Even we saw it's okay float, right? From 2000, I think 2000 or 2002, right? 2001 might be. So it's float, but still the interventions are there. So then we call it managed float. So what do you mean by intervention? We have seen, right? So if it is, you just have a kind of exchange rate imagination. So if that is exchange rate goes beyond that, you intervene the market. Or like it comes down below some extent, you intervene the market and manage it, as we discussed earlier. So these are 3 kinds of regimes, right? And also I have given some kind of explanation how a fixed exchange rate regime works, right? You can understand. Think like, okay, with an example of Chinese, right? Chinese yuan. Now there's always an allegation that the Chinese currency is undervalued, right? So that means US always say China undervaluing its currency. That means now it's, let's assume $1 is equal to 10 yuan, but the US say no, that cannot be a 10 yuan, that should be a 5 yuan, right? So the Chinese undervalue their currency, right? So that is undervalue. Don't get confused. Undervalue is that, right? Because like when you undervalue your currency, your products are much cheaper to foreigners. Then everybody will buy from you, right? When I undervalue my currency, right? So because like if you take $1 is 10 yuan, if a 10 yuan product, if a US customer is going to buy a product from China that's worth of 10 yuan, he can spend only $1 and buy it. But let's assume it's a 5 yuan. Now exchange rate is 5 yuan. Now the problem is he had to spend $2 to buy that. So always Chinese, they wanted to have undervalue. That's what US claim. So then they can do more foreign trade. But that's other party is going to lose because they cannot export, right? So they always push Chinese to become to a par, not undervalue. But Chinese, what they do is, if there's excess dollar, they buy from the market, right? And keep always undervalue. That's what Chinese reserve always accumulating, right? The big sum of reserve they are having because they have undervalued currency, right? So you have to buy or sell in the market. It's based on whether you have undervalue or you have overvalue. So you have to buy or sell the dollars intervening the market, right? So you have to always maintain that fixed. It's explained in this graph. You could see an European monetary system. I have just given how that works, because European monetary system, it's collection of countries. Their monetary policies, there's a big difference, because here we have one country, one monetary policy. But if you take European monetary system, several countries, several monetary policies, but one currency, right? So one currency means it's fixed. That means exchange rate is common for every countries, but they have different monetary policies, a different economy. So it's too complex one. That's what I just given some kind of ideas on that. Just if you are interested, you can see how that works as well. Very interesting one. Okay. I just skip that, right? This graph, it's talk about that sterling pound one. But this is one important theory I just want to explain to you as well. We call it impossible trinity, right? Why we call it impossible trinity? Because there are three aspects in the economy, right? One, independent monetary policy. Two, fixed exchange rate. Three, free capital mobility. If any country, if they want to follow fixed exchange rate, and if their monetary policy is independent, they cannot stop free capital mobility. Or if any country wants to have free capital mobility and independent monetary system, they cannot have fixed exchange rate. Or if some country wants to have fixed exchange rate and free capital mobility, they cannot have independent monetary policy. This is what it says. Nobody can put all these three together and maintain. You can maintain only two strategies at a time. You cannot maintain these three strategies. Right? Now let's take one example. I will explain. Now, a country is having fixed exchange rate, right? So when it comes to fixed exchange rate, and also that means exchange rate is fixed. And also if you have independent monetary policy, when it comes to independent monetary policy, your target is price stability, right? You always work towards that, no other agenda. You are totally independent, right? So what will happen when the exchange rate is fixed? You have to back buy, right? So when you back buy this foreign exchange rate fixed, right, you cannot let it go capital, because like let's assume now you have the interest rate here, right, locally, right, a low interest rate, so low return. Then what will happen? And also you want to maintain a fixed exchange rate. We have seen earlier in our discussions, when you have low interest rate, then that will go and affect the exchange rate. There will be changes in the exchange rate. right? But when you have interest rate low and fixed exchange rate, so there won't be any changes in the exchange rate. So the investors will think, okay, this is not going to give us a proper return. So I have to move from Sri Lanka to some other country. So capital will move, they will pull out the capital from here and invest somewhere. So definitely you cannot stop them. Right? So now the thing is, here you cannot have it free capital mobility, because if you let them go, what will happen? You are unable to maintain fixed exchange rate. Then if you want to maintain fixed exchange rate and independent monetary policy, you cannot have free capital mobility, because if everybody pull out, you cannot maintain fixed exchange rate. So if you want to have free capital mobility and fixed exchange rate, definitely you have to intervene in the market. You cannot have independent monetary policy. Right? So just think, like for exam purpose, you don't need to go into that details, but you have to, in general, what you have to understand is, when you study about exchange rate analysis, yes, with the conduct of monetary policy, you should be able to understand, okay, a country cannot have all three together. They can maintain only 2 out of these 3. That's what it called impossible trinity. Right? I'm not going to ask any question on this. I know this time factor is not sufficient, but you think there's a theory like this, and if you want further, you can read from the book even, right? It's available. Just have a look. And manage float, I have explained to you already, right? And right, this all about impossible trinity, you can read. Okay, now we have seen, when we discuss about monetary policy, we have discussed about so many strategies. One is inflation targeting, other one is exchange rate targeting, or multiple targetings, or income targetings. The several targeting we have discussed. One of the items we discuss is exchange rate targeting. So now Singapore and all, merely they are very close to have exchange rate targeting with US dollar, right? So the advantage of exchange rate targeting, because like, okay, they target this exchange rate, okay, this is what they wanted to have, right? So when you target that, that contributes to control the inflation, because like you are importing a lot of goods and services, right? So like a country like Singapore, they depends on a lot of imports goods, right? So if you maintain a kind of fixed exchange rate, your price will not fluctuate, right? So local product will be the same price, right? That's what those kind of that very open countries who heavily depends on imports goods, they wanted to maintain some kind of exchange rate target, right? So you can control the inflation, and it's an automatic rule for conduct of monetary policy. Then you want to have exchange rate target, so you work towards that, right? So nothing else, you don't worry about anything else. Try to maintain exchange rate targeting. So once the figure is given, so it's a rule you have to follow, right? You cannot go like different perspective. So only thing is like your hands are, you know, tied up, right? It's very good for some countries. Some countries are unable to handle, even central bank. We were talking about inflation targeting, but once we fix that inflation, you are answerable, you are accountable for that, right? Now if you say 5%, then the general public will ask, your mandate is 5%, why it has gone up, right? So you have to activate your monetary policy in a rule, right? Automatic rule. But if you don't have any target, you don't have that kind of issue, right? And it's straightforward. Everybody knows this is your target, and the bank will be working on to that target. It's very simple and clear. Everybody knows exchange rate. So like within small fluctuation, so you can do your business without any issue. So those are advantages. But a disadvantage, cannot respond to domestic shocks, right? Because like, okay, there's a shock, right? You can't leave the exchange rate to fluctuate, right? You have to always somehow, on whatever the base, you have to maintain your exchange rate target, right? The shocks can be coming from various various means. Now example, over the world, maybe food inflation, food prices are going up, right? So you have to maintain your exchange rate, whatever happens, right? Or something happened to a local market, right? So here, like if you are unable to keep the exchange rate, you have to leave it. You have the mandate, okay, it can be 200 and 230, you can leave it. But there, once you fix it, then you cannot do that. That's what the problem, right? You cannot respond to the shocks by relaxing the exchange rate. And if you think, okay, this is fixed, anybody can try to get the gain out of the market differences, right? So everybody looking at this, because okay, this country's exchange rate is fixed, we can try to calculate and, you know, speculate the exchange rate, and we can have some kind of gain out of that. And also we can say accountability of policymakers as the exchange rate losses value as signal, right? Even you try to maintain, right? But if you are losing the value, then your accountability will be weakening. Now, if you don't fix it, even in Sri Lanka, okay, we don't fix it with any inflation targeting or exchange rate targeting. So we could be able to, even that is fluctuate in high level, we maintain our accountability. Nobody is going to question, okay, what happened? In the sense, like, as an example, I am telling, right? So there won't be any severe attack. But once you fix it and your currency is losing its value, then you are accountable because you have already fixed it, right? So that is the disadvantage here. And there are some examples I have given with regard to industrial countries, whether it's exchange rate targeting is desirable or not. It's just text you to think, right? Or what about emerging market? And you can, these are some kind of scenarios to think, right? You just keep in mind. Overall, we have discussed exchange rate, what is exchange rate and what is the market and who are the players and how that works. That is a very important part, right? So how that works. So that is very important. I hope you understand, but it's a bigger subject, right? We cannot cover in a 3 hours time, right? if you are going to work with examples and covering all the aspects, it's within 3 hours. It's not as, you know, it's kind of been a time to discuss. That's what I rushed through, but still given the reference to the book, each and every slides you could get the clear understanding from the book. I hope these are all lectures you might have, you know, understood to the extent this course requires, right? Some of the areas I've given a little bit excess, but of course that's for the betterment of your understanding. Okay, this what I have covered the course materials or syllabus as much as possible. I hope you also understand. If you don't understand, you have the recordings and go through, and also you can read the, I suggest, encourage you all to read the book as well. When it comes to exam, right, altogether 8 questions, right, and 4 questions from my area, what we have discussed. All questions will be coming out of the slides, right, and mainly within the area also, right, mainly where we have discussed the graphs, right, some explanatory item. The exam structures might be like out of one question has 4 sub questions, and maybe very straightforward basic questions also will be part of that, and maybe some explanatory questions also. The explanatory questions may be covering the graph we discussed, right, and each and every area you will be getting 1 question. So I encourage you all to study all the slides and give more concentration on few basic aspects as well as the graphs explanation, right, explanation through graphs. That's it from my end. If you all want to ask any question, and also you can note my email ID, right, I just put it here in the message or chat box. Okay, this is okay. Only if you need explanation, please convey to me. Before that, you read the book, and if you don't understand anything, just you can text it to me as well, so I can look into that, and as much as possible I will try to respond to your questions. Okay, if you, from your point of view, if you want to ask any questions, you can ask. This time for you.
So the paper will be prepared by you, sir? Or?
Sorry?
Or will the paper prepared by you or Mr. Jeevanta, or both together?
That's a good question, right? But I can assure that the question will be within the slides, what we discussed, nothing from outside, and whatever we discussed. Any other question? 4 questions from my discussions, and 4 questions from Mr. Jeevanta's discussions, right? So the 4 questions from my discussion within these slides and within these 4 areas, major areas. Maybe sometimes mixture of 2 areas, but anyway, it won't be that hard. How this, especially the monetary policies and all, please listen to that, right? Okay, if there's no more question, I think I can wind up, and thank you so much for patience. I know like how difficult it is attend a class. We used to get only few holidays, right, or weekends, but during that time also like we spend on classes. But only one thing I just want to remind you, it's a big sacrifice, right? So you have attended all these classes, so it's the final hurdle is there, right? If you fail to jump, then it's all your effort is, right, going to be waste. So please just try to, read it again. uh, don't try your luck, right? Try to study, and I'm sure like exam won't be very hard, right? It's simple and straightforward. Unless you just ignore, then you will have a problem. Otherwise I don't think you will have a problem. So it's very easy. Please try hard, because this is the up to now anyway gone. This is the next few weeks that's going to determine whether you have spent your time at least for a worth course. Okay. Thank you so much and good luck.